Good afternoon, ladies and gentlemen, and welcome to the Victoria PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Executive Chairman Jeff Wilding. Good afternoon, sir.
Good afternoon. Thank you everybody for joining the presentation. And before we get into dealing with the results, I'm just going to talk briefly about the elephant in the room, which is the delayed audit. Clearly, as a board and management team, we're very, very disappointed in the delay. It's not something we expected or wanted to see, but nonetheless, it will be completed in the near future. What I wanted to emphasize, though, that it is purely routine audit procedures that are being finalized on the business, and it includes things such as, and I'm just going to read the list to keep it very simple, there's only 6 items: testing and valuations of goodwill, some complexity around the reverse carve-out of Bolter, testing around finalizing property, plant and equipment valuations, finalization of pension work, finalization of hyperinflation adjustments. This relates to the business that we have in Turkey. Testing of revenue and compliance with regulations of a minor subsidiary, finalization of tax work. So the work that's outstanding is just routine audit procedures. So with that, I'll now want to move on to the results that we've achieved for the last FY23. It was obviously a very difficult year in terms of the macro environment. Demand was subdued compared to the previous 12 months. There was inflation. We also had to deal with extreme energy prices during the year. It's easy to forget now, but this time last year, energy prices were running at 200 to 300 euros a megawatt hour for gas in Europe, and that as opposed to a normal level of anything around 40 to 50 euros a megawatt hour. Nonetheless, Philip and the operational management team managed to achieve organic growth in the business and achieve revenue of 1.46 billion. Of course, that does include the acquisition of Bolter, and EBITDA of 196 million. Primarily, the focus of the management team in the last 12 months has been the integration of the acquisitions we've made in recent years. The biggest of these, of course, being Bolter. And although I'll leave Philip to talk about the detail of that with you shortly, the excuse me, the work has involved closing a factory in Belgium and moving our carpet production to the UK. It's also involved consolidating the rug manufacturing in Belgium onto a single site and also moving some of that rug manufacturing to Turkey. The savings on that will result from that will be very material. I'm pleased to say that when we first announced the acquisition of Bolter in April 2022, we said that the integration work would take 2 to 3 years. However, here we are 17 months later, and we expect that work to be fully completed next month, 18 months after, so 6 months faster than the earliest of our initial expectations. Now, what this means, of course, is a considerable saving in terms of labour costs, a improvement in operating margins, and the impact on our earnings will be at least £20 million a year in terms of EBITDA, EBIT, and net profit before tax. So what is going to result from this is obviously our cash flow will improve, and as will earnings, and we're expecting in the current financial year, the consensus numbers in the market which are, I think EBITDA is 214 million is the consensus EBITDA. That is entirely based on self-help. We're not expecting any recovery in demand. That's a steady state demand, even though in recent weeks we have started to see an increased demand, increased volumes coming from customers. However, the focus will be over the next 12 months on reducing leverage. We expect to be very cash generative this year and next year, with the ending of the exceptional expenditure on redundancies, the exceptional capex on relocating plant and machinery, with the finishing of these integration projects, and we will be applying that to reducing leverage. As most people will be aware now, we have a call option on the preference shares beginning in November the 16th, and we will be exercising that call option using the cash that's being generated from the business, and we will be buying back a significant portion over the next year or so of the preference shares. We will also look to buy back bonds as appropriate, with the goal of reducing the company's overall leverage well before the refinancing that is required this in 3 years' time in July 2026. So with that sort of summary of background, I just want to hand over to Philip to take you through the key operational activities that have occurred in the last in FY23.
Okay, I think Brian will do some of these numbers first.
Okay, thanks, Jeff. Good afternoon, everyone. I'm pleased to present a few slides on what has been another record year for Victoria. I will run through some of the financial highlights of the last 12 months, and then Philip will take you through the detail in each of the divisions. As Jeff said, it's been another record year for Victoria, with underlying revenue close to 1.5 billion and our EBITDA close to 200 million in challenging economic conditions that we've had this year. And this slide here shows the exceptional growth track record achieved over the last 5 years, with revenue growing a compound annual growth rate of 28% and EBITDA at just under 25% through a mixture of organic growth and acquisitions. We completed 3 acquisitions in the year, the largest being the carve-out of the rugs and broadloom business Balta, based in Belgium, which completed in April 2022, along with another small complementary rugs manufacturer, Rugol, also in Belgium, which completed in June 2022. These acquisitions now make us the largest soft flooring manufacturer in Europe. The final acquisition of the year was IWT, a distributor of ceramic tiles based in the high-growth state of Florida in the United States, which complements our acquisition of Cali in the prior year and adds to the significant sales of Balta rugs in the US market. We'll move on to the next slide. This bridges the overall group margin from FY22 to FY23, and as you can see, we finished the year with a group underlying margin of 13.4%. On this slide, we've isolated the impact of acquisitions on the results, and this acquisition mix effect comes about as we tend to buy businesses with lower margins than their own, and during the integration period, we expect to see a drag on the overall group margin as we complete our synergy projects. The most significant impact is in Europe and UK and Europe soft flooring division, as we finalise the integration of the Balta acquisition. Balta is being fully integrated into our industry-leading scaled operations this year, and will provide us with significant opportunities in the UK and US markets. In terms of organic growth, our businesses have addressed the challenging environment in terms of demand and inflationary pressures in raw materials, labour and energy to deliver some organic increase in margin. This was achieved by implementing price increases where necessary, being laser focused on cost and synergy initiatives, hedging or managing key input costs where available, and working on product engineering with our customers to mutual benefit. And before I hand you to Philip, just a couple of things on the overall group performance. Revenue growth was over 43% in the past year, and 2.8% on a like-for-like basis when you exclude the impact of acquisitions and foreign currency. And this has resulted in a 33 million increase in the underlying EBITDA year on year for the group. So I'll hand you to Philip to go through the detail.
Okay, thank you, Brian. So I'll talk you through operational FY23 and give you some heads up on the outlook of the current financial year. So first of all, the UK and Europe soft flooring division. This is the largest division, which is mainly UK driven, where we are selling carpet, underlay, and LVT. We are manufacturing UK as we are a distributor in the UK as well. So the profitability, as you can see, was lower in FY23, but as Brian just has explained, the dilutionary effect of the Balta acquisition has an important role, as well as the inflationary costs, which have been addressed in. So the year in this division, the year was dominated by the Balta integration. And for the ones who don't know and who are on the call, Balta is a Belgian tufted and woven rugs manufacturer with a revenue of about 350 million euros. So what we did with that, with Balta, so we bought and acquired Balta mainly for the rug business. And yes, there was a broadloom part, so a carpet part there, but that was not the prime objective of the acquisition. We bought it for the rugs because we do a lot of hard flooring in the group, and we know that hard flooring comes with rugs, and rugs, we can see a good potential growth in the rug market. So what we had to do, and we knew that when we acquired it, so we have restructured the Balta operation, and we have closed one plant in Belgium, as Jeff has mentioned in the introduction. So the plant which was closed, so some of the machinery was relocated to another Belgian plant, and some was relocated to one of the other two Turkish plants which we have in the business. On the broadloom side, on the carpet side, since 80% of that was of the revenue goes to the UK, we've decided to stop that operation, the manufacturing of broadloom carpet in Belgium, and to push it forward to one of our two manufacturing sites, which we have in the UK. One we have in the south of Wales, and one we have in Yorkshire. So this process has led, the Balta restructuring has led to laying off about 500 people. We have conducted 2 social plans in Belgium, which have led to exceptional costs, which Brian has referred to. But it has, as Jeff has mentioned, this has come to conclusion. The people have been laid off. We have stopped manufacturing already in Belgium for the broadloom, and we are fully tufting already product in the UK in one of our 2 plants. If I go to our second largest division, this is UK and Europe ceramic tiles. Yes, we've seen some softer demand, and of course they have also experienced the inflationary pressure on the cost of goods sold. But you've seen, if you look at the result, we have a very positive result there. We are up 410 basis points. And if I look across the geographies, so what we can say, so the management team has done a fantastic job in ceramics. First of all, they've done the value engineering on the product. So they make the ceramic tiles, they made them thinner, they made new product out of it, so which has led to an efficiency gain on the clay on the one side, and also, of course, on the energy, because we are just making more products since the ovens can run faster, the products can run faster in the oven. So the reformulation of tiles was something which was done with the full knowledge and quality guarantee with the customers. Also, and we've said that last year as well, you all know that there was a hedging policy in place, and careful hedging policy was continued in FY23 as it is continued in FY24. And we've also been aggressively selling and basically trying to leverage the distribution which we're having in the US. In the meantime, we have 4 distribution warehouses in the US. We have 1 distribution warehouse of our ceramics distributor, which we acquired last year in FY23 in Florida, so in Palm City. So, and then another component of the US business is Cali Flooring, which is an omni-distributor, an omni-channel distributor in the US, and they have a warehouse in Charleston, and then from the Balta acquisition, we have 2 extra warehouses on the East Coast. So this gives us 4 warehouses, and of course, as you can imagine, we're trying to push forward product into these through these warehouses. So we have a pipeline, and we try to sell more product in the US, which is Europe manufactured. And of course, in the business, not only the restructuring we've done in Belgium in the carpet business, but we've also done some restructuring in the tile business, mainly in Spain, where we've closed also one factory, and in Turkey, where we have stopped producing on some short kilns, which were not very productive. Then 2 more divisions to come, which are the smaller divisions or the group. First of all, there is Australia. Australia, for many years, has been a constant factor in the group. They're pretty small, and they have suffered some of the same inflationary pressure which they have dealt with through price increases. And the demand has been pretty constant. I just want to remember that coming out from the COVID period, they were later out of COVID period, the demand was still pent up. So, and part of that we've seen in FY23. So they have been delivering on a steady state. So FY22, the LVT, so luxury vinyl tile market in Australia, was a bit down for us, but we've nicely recovered in FY23. We came up with good numbers in LVT as well. So Australia was good in the past year and is going to be good in this year as well. Then final division is North America. Okay, I've told you what we have as a distribution facility already. They like to buy European product, and of course, as I said earlier, we are trying to push more of our product, and this is mainly rugs next to ceramic tiles and artificial turf through the distribution channels which we are having. Good. So I think this is, I would like to use the time, since we may be running out of time. So I would like to use the time to give you a bit of an outlook of what we are currently seeing as we are in the 5th month of our new financial year. So overall, we can see the inflationary pressure easing in raw materials. When we speak about the tough market, so let's say the soft flooring market, and we speak about yarn, which is mainly acquired in Turkey, we can see that the prices are much lower than in FY23. So this will definitely generate an upside. We see the same effect as well as of an inflationary easing in the ceramic business, with clay and wrapping and plastic and different other components which are in the cost of goods sold, not to say energy. Of course, energy is at a much lower pace as well. So this is helpful. And yes, we're getting pressure from the customers, but there's also the inventory turns, and we are pushing back to customers. You've seen that we've been working on the productivity, so we don't want to be pushed to fill up the factories. We try to protect the bottom line as we go forward. Energy, I've been mentioning, and of course we've done in the previous year multiple price increases, which were needed to cope with the inflationary pressure. So in terms of demand, the demand outlook, I can see. So if we're talking about UK in the demand, so in the first quarter of next year, so April, June, we've seen that the business was at a very good level still in the UK, albeit a bit less than the previous year. But we've seen in the last weeks that we are selling more carpet today than we did last week. So the business is definitely in a recovery mode in the UK. We haven't seen the full effect of that yet in the US on the rug side, but there we are counting on the top season, which is starting in September, let's say. So we should see effect of that in the second half of this year. Especially something that I want to mention is the end customer visibility, which we're having in the UK. It is very important. So because we're not selling to the middleman or to the wholesaler, let's say. So we are mainly working directly with the retailers, whether that's big box retailers or independent retailers. So we have a clear visibility. We're shipping about 20,000 order lines per week to our 240 vehicles. We have our own distribution in the UK, and we have a good visibility. So an order, if we have a good evaluation of the footfall, which is there, and we can see, we are very confident in what we see coming into these numbers. So there's another slide on the integration of Balta, but I've dealt with that in ceramics as well. There's one little paragraph there on Cali flooring, but okay, this is mainly trying to push the US logistic platforms, trying to incorporate the logistics platforms across the group. And maybe there's another slide, Brian, but maybe you will do that on cash generation.
Yeah.
So, yeah.
Thanks, Philip. So what does all this mean in cash terms? We've gone through a period of high spend around the integration of the projects that we've had. Jeff mentioned the projects right at the start. We're coming out of that now. We have got some spend that we spent so far in FY24. As Jeff said, finalising the Balta acquisition. We've also had an abnormally high level of capex in relation to moving these the equipment in some of these plants into the right place. So what we expect to see is an upturn in the earnings and also an upturn in the cash generation. One area of focus, we mentioned this the half year, was around inventory management and working capital management, and the business has made some good progress on that so far in FY23 and continues that into FY24. One other area that we mentioned at the half year was around the integration costs of Balta. We expect those to be pretty much offset by the sale of non-core assets. We have sold one building in Belgium where the cash will arrive in September, and we are looking at to make sure that our property portfolio is the right size for us, and we will continue where we have got non-core assets to generate cash from those. And then as a board, we have a proactive view of our capital allocation, and as a particular project comes up, we look at that on that individual basis to make sure that we're doing the right thing with our cash to generate the best value for our shareholders. And then overall, we expect that our ratio of leverage will start to come down as we generate cash, as we pay down debt. With the current high interest rates, we are looking to reduce our overall leverage, which we've been comfortable with for the last number of years. And we'll do that, as I said, through increased earnings and also through reducing debt. And I think just finally on this slide, one of the options that we have from a capital allocation point of view is whether we buy back the preference shares. They come open to redemption in 25 million blocks in November 23. And that, along with other allocations of our capital, such as buying back bonds, will be something that the board will keep a continuous eye on. And with that, I'll hand you back to Jeff.
Okay, well, this ends the presentation component, and we'll now open it up to Q&A.
Jeff, Philip, Brian, that's great. And thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Guys, as you can see in the Q&A tab, we have received a number of questions throughout your presentation this afternoon, and thank you to all of those for submitting their questions. But Jeff, if I may just hand back to you to chair the Q&A with the team, and then I'll pick up from you at the end. Thank you.
Right, well, look, as was just said, there's quite a number of questions. I just want to preface the answers that we give with the fact that some of these questions I can see asking non-public inside, asking for a non-public inside information. Clearly, we can't answer those questions. It's not appropriate. So there may be some questions we end up either answering only partially or not answering at all, because we want to, obviously, we need to stay within the regulations. So the first question is asking about whether we are going to buy back bonds before we refinance or just the preference shares. As Brian said at the last part of his commentary a couple of minutes ago, we always look at, as a board, we are always looking to optimise the deployment of our free cash flow to maximise the creation of value on a risk-weighted basis. So Initially, it would be fair to say that in November, we would expect to be buying back some preference shares. That is our expectation. However, we will not be buying back all of them. The intention is just to significantly reduce the amount that we have that are currently issued, and then we would deploy our capital elsewhere, including buying back bonds ahead of the refinance. Sorry, just give me a pause to. We've been asked about where Victoria's head office is. The head office is formally now in Worcester, and that is also so head office is based in Worcester, and the Kidderminster site has been completely closed, where the company's been for the last 30 or 40, no, more like 50 years. The Kidderminster site is now completely closed. Head office is in Worcester. That is also where our Alliance Logistics operation is headquartered, although it's also worth noting that Alliance has a number of other warehouses around the UK in order to maintain the service levels that our customers require. So, Philip, do you want to answer the question about how fragmented the market is across because it depends on which country we're talking about.
Yeah, is that soft flooring or hard flooring?
It doesn't matter, it's just
okay.
So it's...
Yeah, so first of all, in terms of, if we talk about ceramics, the fragmentation of the market, it's massively fragmented. Only in Europe, I think there's about 300 or 350 suppliers. I think even the largest one has a market share of about 2 to 2.5%. So very fragmented. If you compare that with soft flooring, that's a bit less fragmented. Let's say there's about major manufacturers, 6, 7 larger manufacturers left, or groups left, which are dealing with the UK market. Because, okay, mainly when we talk carpet, so I just want to reiterate that when we talk carpet, we talk mainly carpet into the UK market and into Australia. That's where we're having plants. And if I say carpet, I'm talking broadloom, not rugs. If we're talking rugs, we're talking for 50% US market and 50% non-US. Yeah. Anything else there?
There's also a question on talking about current demand and volume and price development. Maybe you can expand a bit further on that. But
yeah, well, I think I've touched on demand in definitely in the UK, so I don't need to repeat that. But maybe in ceramics, we can see that the ceramics business, especially the component from Italy, where we're doing most of the DIY business, is still going strong and from strength to strength. So we are okay with the current demand. Let me see what other questions.
I'll just keep scrolling down. There's a whole pile of questions just asking about what current demand is like, which Philip's answered. So I'm just trying to scroll through those.
Yeah, sure.
So somebody's asked just for a bit more colour around why we would buy back the preference shares. And I just want to emphasise that it's all about deploying capital to maximise the value of Victoria on a risk-weighted basis, and the preference shares carry a dividend, which is so they're not free, and since we have the free cash flow, it makes sense to buy them back. Having said that, Coke, I just want to make clear, also holds about 11.5% of the ordinary shares, which is where they expect to make most of their gain. And so we have a Coke director on our board who is supportive of us buying back the preference shares. And I want to make that clear that Coke have been a fantastic partner for us. They will continue to be in the years ahead. And the relationship is very, very strong. They've been extremely helpful in helping us to grow in the United States, where, as I think Philip mentioned earlier, our revenues now, they're around $400 million a year. and we expect to see significant growth going forward.
You've covered most of the ones.
Yeah, sorry, there's an enormous amount of repetition. I appreciate everybody can't see that, but I'm scrolling down. So there's a question again about assuming that the market just stays at current levels rather than a recovery in demand, how confident we are in the outlook for our numbers. I wanted to make it really clear that the numbers and in the FY24 and FY25 numbers that are in the consensus, the City consensus numbers, do not incorporate any recovery in demand. We are assuming flat demand. The uplift in earnings or the increased earnings you can see in FY24 and FY25 in the consensus is based purely on self-help. Philip mentioned that we have made more than 1,000 people redundant in the last 12 months as a result of the integration projects. And so those salary costs are no longer being paid. And that plus a few other components around productivity improvements in the factories as a result of the integration is what's driving the uplift in earnings. So it's our expectation that if there is a recovery in demand, every 5% improvement in revenue would lead to a £25 million plus increase in earnings. Now, the reason I've chosen 5% is that happens to be the long run average organic growth rate of Victoria. So that is not built into the numbers again, but should recovery when recovery happens, every 5% increase in revenue will drop through to a 5% to 25 million improvement in earnings and 25 million improvement in cash flow. There's just a quick question about the coupon on the preference shares. I think it's 8.35%. 8.35%.
I think that's pretty much the last question.
Yes, it is. Oh, sorry, there's a question about headwind to earnings from energy hedges. I just want to make it clear that the way we structure our energy hedges and energy contracts is they're rolling. We don't have a drag on earnings. So in other words, we are not contracted to pay higher than market prices in FY24 for our energy costs. So the short answer to the question is there is no drag.
Yeah, and I think the last question, Jeff. That's it.
That's it. All right. Well, thank you very much. And that's the end of the presentation. And of course, if anybody wishes to submit further questions we'll be happy to look at them and provide answers in writing through the Investor Meet company.
Jeff, Philip, Brian, absolutely. And thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors this afternoon. And of course, as you kindly just said, we will be able to give you back all of the questions and any further questions that do come through just for you to review. And of course, we'll be able to add to those responses when we publish them out on the platform. But thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Victoria PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thanks very much.
Thank you.